The top 1% of Americans hold nearly 76% of the nation's wealth. But it's not just about how much they earn, it's about how they think about money. So in this video, my AI assistant Tiara and I will teach the strategic saving, investing, and spending habits of the 1%. So Tiara, how should we begin this one?
Let's get right into their mindset shifts.
Yeah, I think that it's often overlooked too. So I like what you're thinking here, Tiara. So when it comes to money, the wealthiest individuals, they often have a fundamentally different mindset compared to the average person, right? So one of the most significant shifts is how they perceive failure. So instead of viewing setbacks as insurmountable obstacles, they see them as valuable lessons instead. For example, when Elon Musk faced multiple failures with Tesla, he didn't just retreat in despair, right?
Yeah, I bet you just cried yourself to sleep.
Instead, he analyzed what went wrong, adjusted his strategy, and ultimately did succeed. Now, this approach, it transforms failures into stepping stones towards success, allowing them to learn and grow from their own experiences. Now, from my own experience, I will say that I have always said that there's no such thing as a failure so long as you learn something and don't repeat the mistake again. But that's just my take. Now, another crucial aspect is their comfort with calculated risks. So wealthy individuals, they tend to embrace opportunities that others might kind of shy away from due to their fear of loss. They understand that true financial growth, it often requires stepping outside conventional safety nets. And actually, a little bit later in this video, I'll share one counterintuitive strategy that the rich, they use to build wealth, which probably goes against everything that you've been taught about money management. But in terms of the wealthy taking calculated risk, here's a good example, right? So a savvy investor, for instance, they might buy a property in an up and coming neighborhood that kind of seems risky at first, but they've done their homework and they recognize the potential for the long-term appreciation, which can yield significant returns over time. Now, this mindset of viewing risk through a lens of opportunity rather than fear, that is just absolutely essential for success. Beyond that, the 1% often adopts a long-term perspective on their investments and their financial strategies, which I have to say, I talk a lot about being long-term in your investments on this channel, along with a bunch of other helpful information. So if you could, please subscribe to the channel to help me achieve my goal of helping thousands of people with their finances and the ability to support my own family of 4. And if you do, obviously, I appreciate that so much. But back to the long-term investment mindset here. Many people chase quick wins. Wealthy individuals, they focus on sustainable growth over years or even decades, right? They know that compounding interest can work wonders if given enough time. So for example, instead of flipping houses for an immediate profit, right, they may hold on to real estate for 10 or 15 years, benefiting from both appreciation and rental income during that period. And finally, they cultivate an abundance mindset, right? Believing that there are always more opportunities available. And this perspective, it encourages innovation and collaboration rather than worrying about competition or having jealousy. So when faced with challenges, they ask themselves how they can create value and kind of differentiate themselves instead of just competing for existing resources instead. But it definitely doesn't stop with just the mindset. So Tiara, what else do the 1%ers do here?
How about strategic saving and spending?
Absolutely. So first off, the wealthy, they tend to flip the script on the whole, pay yourself last mentality. So instead of saving what's left after spending, they usually will save first and spend what's left from there. And it's not uncommon for high earners to sock away 20, 30, or even 50% of their income before touching a dime for anything else. Now, if you think of that silly, realize that this isn't just about having a large amount of cash available, right? It's about creating a pool of capital that they can use to invest and grow their wealth in whatever ways they'd like, whether it be, the stock market, real estate, or, becoming an investor in other businesses, or even starting their own business. The wealthy are also quite intentional about their spending. They're not afraid to shell out for, quality items that will last or experiences that truly matter to them. However, they're also masters at avoiding lifestyle inflation, meaning that just because they can afford a flashy car, that doesn't mean that they'll buy one. So Warren Buffett, for instance, is one of the wealthiest people in the world, but still lives in the same house that he bought in 1958 for just over $31,000. And another trick that is up their sleeve is leveraging tax advantage accounts to the max, right? So whether it's maxing out their 401ks, utilizing Roth IRAs, or setting up, health savings accounts, they know how to make the tax code work in their favor. And this not only helps them save more, but also reduces their tax burden, leaving more money to invest and grow. And lastly, the 1% often practice what's called conscious spending. So they are hyper aware of where their money is going, and they regularly review their expenses to ensure that they're aligned with their values and goals.
unlike the rest of us who just close our eyes and pray when checking our bank statements.
God, I hate that this is true for some people, but TR, you aren't wrong here. Now, saving and spending habits, they are great, but it isn't the best way that they grow their wealth. TR, what is a better way of actually doing that?
I'd say it's their habit of investing for growth.
Yeah, and I'd agree with you. So first off, the wealthy understand the power of diversification. Okay? They don't put all their eggs in one basket. Instead, what they do is they spread their investments across various asset classes like stocks, bonds, real estate, or even alternative investments like private equity, hedge funds, or angel investing. These different strategies, they help manage risk while maximizing their potential returns. Now, one key principle that the 1% swear by, and I always talk about this in my videos, is the power of compound interest. In fact, I even created a video that talks heavily about this topic, which I'll share a link to this later in the video, but the 1% start investing early and consistently, allowing their money to really grow exponentially over time. The wealthy also tend to focus on growth investing, particularly in their younger years. So they look for companies or assets with high potential for future appreciation, even if they're not currently profitable. So think of early investors in companies like Amazon or Tesla. They saw the long-term potential and they reaped massive rewards. Granted, these are extreme examples, I understand that, but the point is that they aren't scared to go big early on. And another strategy favored by the 1% is what they call dollar cost averaging. So instead of trying to time the market, they will invest a fixed amount regularly, regardless of market conditions. This approach, it helps smooth out the impact of market volatility over time. Many in the 1% also leverage tax efficient investment strategies. So they might use tax loss harvesting to offset gains, or they may hold investments long-term to benefit from lower capital gains tax rates. And I mentioned this earlier, but they also may contribute to tax advantage accounts like 401ks, Roth IRAs, or they have businesses that help them with tax incentives like depreciation and other write-offs that heavily benefit their taxes. Now you have to understand, for the 1%, taxes are one of their biggest expenses, so they spend a lot of time optimizing it. And if you personally make, over $200,000 per year, it's something that you should pay attention to as well. And a quick reminder, stay with me here, because the one counterintuitive strategy that the 1% use that I mentioned in the intro, it's coming up here shortly. Now, it isn't all completely fair either, because the wealthy, they often have access to exclusive investment opportunities not available to the general public. And this might include, pre-IPO stocks, real estate, or private equity deals. While these can be, much higher risk, they also offer the potential for outsized returns. I think the key thing to remember is that to the 1%, success isn't just about making money, it's about making their money work for them 24/7, 365 days a year. All right, so Tiara, where do we go to next here?
How about networking and relationships?
Yeah, so definitely. So for the ultra wealthy, networking isn't just about collecting business cards or racking up LinkedIn connections, right? It's about building a web of meaningful relationships that can open doors, provide valuable insights, and create opportunities that money really can't buy. So the 1% often live by the mantra, your network is your net worth. And they understand that who you know can be just as important as what you know. And these connections, they can lead to insider information about investment opportunities, which is technically illegal, but they play their game.
I wouldn't know anything about that, sir.
Introductions to key decision makers, or partnerships that can take their businesses to the next level. And one strategy that the wealthy use is to join exclusive clubs or organizations as well. So think about country clubs, yacht clubs, or even high-end business associations. These aren't just for show. They're really hot spots for rubbing elbows with other successful individuals in various industries to expose themselves to different levels of thinking. It's not uncommon for million-dollar deals to be struck on the golf course or over a fancy dinner. Now, this may not be accessible to you, and it's not to me either, but social media has made it easier to get more powerful connections than ever before. So invest time and effort while sharing value, and you really never know where it'll lead you on social media. The 1% also prioritize attending high-level conferences and events. So these gatherings, they aren't just about listening to speakers. They're about the conversations that happen in between the sessions. A chance encounter in the hallway could lead them to a really, really big break or a great investment, something like that.
Or, more realistically, just an awkward nod and a weird silence as you both reach for the same stale conference bagel.
Yeah, sometimes things are just funny because they're true. But another key aspect is the concept of giving before you get, right? So the wealthy often look for ways to add value to their relationships without expecting immediate returns. And this could mean, making introductions, sharing knowledge, or even offering resources. And by being a go-to person in their network, they build goodwill that often pays off in unexpected ways down the line. Okay, so I already mentioned this a few times, but Tiara, can we get into the counterintuitive strategy that most likely goes against everything that they've been taught? Can we get into that?
Sure. The answer there is leveraging debt and credit.
All right, so this approach is really a game changer in wealth building, and it really sets the 1% apart from the average person who often views debt as something that they want to avoid. Now, I'll start out by saying that I don't know if this is for everyone, but it can be really, really powerful if used effectively. So the wealthy strategically use good debt to acquire assets that appreciate in value or generate income. So for example, they might take out a mortgage to purchase rental properties and then using those tenants' rents to cover the loan payments while the property value will increase over time. And one popular strategy among the rich is what they call the buy, borrow, and die approach. So instead of selling assets and triggering capital gains taxes, they will just borrow against their assets. So this allows them to access cash while keeping their wealth invested and growing. Now, for instance, they might use a line of credit and borrow against their stock portfolio at really low interest rates. And another sophisticated tool in their arsenal is leveraging life insurance policies, believe it or not, particularly whole life policies. So by borrowing against the cash value of these policies, they can access tax-free funds while still maintaining the death benefit. In some cases, they can even write off the interest on those loans too, which gets a little bit complicated, but they can do that. Perhaps the most powerful concept that the wealthy employ is actually arbitrage. So they borrow at low interest rates and they invest the funds in opportunities that yield higher returns. So this spread between the cost of borrowing and the return on investment is where significant wealth can be built. Now, while these strategies, they can be incredibly effective, it's crucial to note that they do come with risks, right? So the wealthy, they're careful to maintain a balance, ensuring that they don't over leverage themselves and they can kind of weather those market fluctuations. And it's worth mentioning myself, I'm a little bit risk adverse, so I don't leverage debt either. So it can be done without it, but it is a game changer if you get it right. Speaking of risks, earlier I mentioned a video that's heavily influenced by compound interest, which is one of the, frankly, least risky things about investing. And you can find that video right here. Or if that one doesn't suit you, check out this other video that we have over here. But before you go, remember to subscribe to unlock financial success one AI chat at a time.